What is going on YouTube and my stock market bulls and bears? It is your boy Terry Z here, and today we're going to do a little beginner's guide on buying a put and buying a call. And for this example, we're going to use CCL, good old Carnival Cruise Lines. So we're going to explain what is the difference between buying a call and buying a put, and we're going to keep it very, very basic just to kind of let you know what each of them really is and what they mean. So we're going to go to trade CCL options. So as you see, you get on here, we got over here, you can buy a call. So we're going to explain, what does buying a call mean? So basically, buying a call means that you're expecting the stock to go up in price. So right now the share price is $14.60. Let's say that you wanted to purchase this $15 contract. So you're hoping Carnival would go up to $15. So let's click on this here and look down here at the bottom. So basically, if you would purchase this contract for $17, because that's 17 cents times 100, each contract is always times 100, so that's why it's $17 for this contract. Now, I guess that is not, it's only 2 days away, so actually let me change this. Let me go like a week out. Maybe that'll be better. There we go. Let's do buy a call for August 7th, because that's about a week out from now, a week and a couple days. So share price is $14.60. Let's say we want to buy this same $15 call option. So basically, when you buy a call, you're betting on the stock to go up in price. Now you'd have to pay $54 for this contract. So down here in the Greeks, the big thing you want to look at is the delta. The reason for that is every dollar that the stock moves, that is how much money you're going to make. So see the delta of 0.4445. So you times that by 100. So basically, you get $44.45 for every dollar that this stock moves up in price. So that's pretty nice. So this stock goes up to $15.60, $16.60. Now keep in mind, you are paying like $54 for this contract. So you really need this price to go up about $1.50 to maybe break even. And when you actually do a purchase on this, it'll give you the breakdown of your break-even price. Now I'm not going to purchase that option, but kind of gives you a breakdown. So what you're hoping for is on expiration day, August 7th, which I think is next Friday, you want the stock price to go up as high as it can go. I mean, you know how Tesla and stuff can just shoot up really crazy, and just like Kodak has shot up. So if this stock, shot up, let's just say $4. Just for an example, let's say the stock price went up to $18.60 on closing day. You paid $54, and you made basically, say, $45 times 4, which is $180. So that's a pretty good profit there. You made about $140, $150, just for an example. So anytime that you are buying a call, you are betting on the stock to go up in price. So you better pick a stock that you are pretty confident that the stock would go up, like Apple, Facebook, AMD now is really hot since Intel has messed up on their new chips. But yeah, that's basically buying a call. Basically, you're betting that the stock price is going to go up. So that is a pretty good example. Now let's go on to the opposite of this. So let's just back out. And let's go back into Carnival again. We're just doing this to reset ourselves, and we're going to go trade options. And let's say that you think that Carnival is going to go down in price. So you're like, I want to buy a put, because you're thinking that the CDC is not going to let Carnival Cruise Lines sell any boats until they get a vaccine out. And you're just saying, there's no way this stock's going to go up, that there's going to be more bad news. You know, you have all this news thinking that I want to go switch my dates to August 7th. So you're betting that the stock is going to go down in price because you just see that's the way it's going to go with, you know, rising cases of the Rona, no vaccine, just, you know, all that. You're thinking this price is going to go down. I'm going to capitalize on it and make some money. So you're buying a put because you're thinking that the stock price is going to go down. So let's just say you purchase this contract right here. $14 contract is going to cost you $48 over here now for this contract. So you need a stock to go down, you know, down $1 from $14.60. So $14, we're going to click on it. And as you can see on the Greeks, it is negative 0.3419, which is basically $34.19. So every dollar that this stock goes down, you are going to make basically, let's say $34. We're not going to worry about the 19 cents, or we can just round it up to $35. We're not going to worry about change, but let's just say $35 for math purposes here. So every dollar this stock goes down, you are going to make $35. Now, if we go back up, you are paying $48 for the contract, so you basically need this stock to go down at least $1.50 to $2 to start breaking even. And let's just say Carnival gets the really bad news and the CDC says that there is no cruising for the rest of the year, and there is no cruising until there is a vaccine, and that's the bottom line. Let's just say that news came out, because right now cruise lines are not sailing at least till October, and Norwegian Cruise Line just announced they are not even sailing in October. I don't really think cruise lines are going to be sailing anytime soon, but unless there's a vaccine. So if this price is $14.60 and we're going to make, say, $35 for every, let's just say this thing goes back down to like $8. Let's just say for some reason cruise lines are tanking, they're announcing they may go bankrupt. So you're talking basically $14 down to $8. So you got a $6 times $6 times the $35 profit, which would basically be $210, and you paid $48. So you basically made about $150, $160. So that's how you can really make some money on buying puts and buying calls. So basically, quick summary, buying a call is just saying that you're betting the stock is going up. Buying a put is basically saying you're betting the stock is going down. Now, those are a little expensive examples for if you're starting out, but let's just go back in here to trade. You can take out of the money options to where they're not really too expensive. Like this contract's only $3, so let's click on that. But as you can see here now, for every dollar this contract moves is basically 60 cents. Wow, maybe that's not a good example. But yeah, I mean, as you can see, it's like 90 cents. But I mean, you are only paying $4, so you know, that kind of is what it is there. So the higher up you go is the cheaper your contract, which is definitely good for you. You're not risking as much, but it is definitely gonna, if you are right and the stock shoots up in price, you might have lost out on some money, because as you can see, the closer down here you go, the higher the Greeks is. Like I said, this one's like $34. Yeah, $34, and it's costing you 17 for the contract. So you'd have to really hope the stock would go up $1. Now that's saying in, like, you know, a day basically, but you know, it's possible. So that is basically a quick video on explaining what is buying a call and buying a put. Like I said, buying a call, you're betting the stock goes up. Buying a put, you're betting the stock goes down. And the most money you can ever lose is the amount of your contract. Basically, let's say you bet on this contract right here, you purchase this $17 call contract, and let's say Carnival doesn't reach above $15, and let's just say it stays at the same price. It doesn't do anything, it stays at $14.60. You lost $17. So that's the most you can lose. Same with buying a put. If you're betting the stock is going to go down, you say you buy this $27 contract, and let's say the price of Carnival goes up and you were wrong, well, you only lost $27. So buying puts and options is kind of really risky. If you do it, I'd recommend starting out low amounts. That's exactly what I did here on this little contract I'll show you. On this GE put contract, it was a little bit of a risk, but I just figured I'd go in and test the waters of buying my first ever put contract. Trying to get my level 3 trades enabled to do debit and credit spreads. As you can see here, I did $11 contract. My break-even price is basically I need GE to get down to $6.39 at the end of Friday when the stock market closes. So that is what we need. We just needed to get down below there. I'll break even. If it goes lower, that'll be even good for me. That'll even be better. If it goes lower, I'll make a little money on it, and that'll be pretty cool. Then I'll have this in my record to kind of show my mistakes of, doing this. So, all right, guys, I hope this video really helped you out. Please comment below if this helped you. It didn't help you. It really helps me out. And I got more videos coming, so please subscribe. And please leave a like on the video. It really helps share it with others. And also, there's a link down below, guys. If you click on that Robinhood link and open up an account with Robinhood, using my link your bank account, get some money in there. You'll get a free stock, I'll get a free stock, and I will post it on the channel and show you what I get. So, all right, guys, I'll catch you all in the next one. And remember, Z Nation for life.